Thank you, Dean England. So the first substantive session of this conference is an update on CRA, Community Reinvestment Act regulations. It'll be presented by Megan Cheney, who I'm introducing. Megan has been a staff person for Senator Sherrod Brown for 12 years, and she's been professional staff for the Committee on Banking, Housing, and Urban Affairs for 9 years. And in my personal experience, Megan has been extremely helpful in working with community organizations, at least in Northeast Ohio, housing advocates and community advocates. So Megan, we absolutely welcome you. I do want to say for everybody's benefit that if you have questions during Megan's presentation, please put them into the chat. And then when she's done speaking, we'll go back to the chat and we'll do those questions in the order in which they're put in there. So Megan, take it away. You've got the floor.
Great. Thanks so much, Frank. And I am going to make an attempt to share my screen so that I can share some slides on the Community Reinvestment Act. We'll see how this goes. Give me just 1 second here. Okay. And first, I should say just thank you so much for having me and inviting me to participate today. This is it's a big undertaking here, the update to the Community Reinvestment Act rule that was put out in October, and it's an exciting time in CRA. So first I should say that Congress did not write the Community Reinvestment Act regulation. This is the first major regulatory update to CRA since 1995. So it's been a long time coming, and it's a big change. But this was written together by the 3 federal banking regulators who oversee and enforce the Community Reinvestment Act, and that's the Federal Reserve, the Federal Deposit Insurance Corporation, and the OCC. So the CRA applies to all federally insured depository institutions, and so or federally insured banks, I should say. So this rule will apply to all of them. So the regulators outlined some objectives of the update. I put them all on here, but I think, a few that I'll just highlight are really to strengthen the achievement and the purposes of CRA and to adapt to some of the changes that have been happening in the banking industry, particularly the expanded role of mobile and online banking. They were also trying to make things a little more consistent across the agencies and to tailor the performance standards that they set up to banks of different sizes and business models. And there's also some elements in here that promote greater transparency, and I think will give groups like many of those on the call today an opportunity to see what type of lending and investment their local lending institutions are doing in their community. So a couple of quick updates on the changes. They changed some of the size thresholds for banks. So which and what size bank it is determines kind of what tests apply, and what types of Community Reinvestment Act assessments they'll be subject to. So the small banks are anything with assets in at least one of the last 2 years of less than $600 million. Intermediate banks are between $600 million and $2 billion in assets, and large banks are anything with $2 billion or more in assets. And then slightly less common, but I'll still mention them, they're limited purpose banks, which are evaluated separately, and also military banks that primarily serve members of the military, have some slight nuances to their tests as well. So the testing framework, there's different tests, as I said, for all the different sizes of institutions. Small banks they have a choice. They can either continue to use the existing lending test that's been in place, or they can use the new retail lending test that we'll talk about. Intermediate banks have the new retail lending test that we'll talk about, and can either use the current community development test or the new community development financing test. And then large banks, they will have kind of 4 tests that they will be looked at when they do their when the regulators do their performance evaluations. They're a retail lending test, retail services and products test, community development financing test, and community development services test. limited purpose banks, and those are ones that don't really engage in retail activity, things like, you know, mortgages, small business loans. They just are subject to the community development financing test. And so when regulators are looking to assign ratings for CRA, and every bank gets an overall rating of outstanding, satisfactory, needs to improve, or substantial noncompliance. So when regulators are assigning those ratings, they take into account these different tests that we'll talk about. And so they're weighted differently. Every test has a weight that's assigned to help kind of determine that final rating. And so banks are going to be evaluated in a few different geographies. You know, as they are today, they'll still be evaluated in facility-based assessment areas. So the places where a bank has a branch, or a deposit-taking remote service facility. A lot of times that's an ATM or something like that, or a main office. But for large banks, they're also who engage in a significant amount of either mortgage or small business lending outside of where they have these facility-based assessment areas. They'll also be evaluated on their retail lending in the new retail lending assessment areas. And this really kind of accounts for that change in banking, where we have more and more mobile banking, people accessing banks that maybe aren't local to them. So now if a bank doesn't do a lot of that outside of their assessment area activity, then they don't have to have retail lending assessment areas. But that's something that's new and will apply to large banks. And then the outside retail lending assessment areas, these are areas for large banks with a lot of retail lending outside of their facility-based assessment areas and outside of those retail lending assessment areas, and also intermediate banks that originate a lot of their consumer retail loans outside of those facility-based assessment areas that we talked about. And so it really includes just the entire nationwide area outside of the facility-based assessment areas and retail lending assessment areas where a bank would be doing business. And so regulators would be looking at that as well to see who is getting access to particularly home mortgage loans, small business loans, and small farm loans in those areas. And then for community development, which I'm sure is important to many, many of the folks on this call, all banks are going to receive consideration for any of the community development activities that they're doing, whether it's loans, investments, or services, anywhere in the country. But there's greater weight put to the community development that's done in their facility-based assessment areas. So trying to really keep that kind of, I think regulators really tried to keep that kind of local footprint, the importance of the branches and branch network, which is something that I think a number of folks commented on during the pretty extensive CRA revision process. So I'll just run through the tests quickly. I know this is a lot of information, and the rule itself is much, much more detailed. So I definitely recommend taking a look at that if you're interested in the nitty-gritty of it. And I'm happy to talk more about that too with anyone who wants to follow up offline. So the retail lending test, and this is the one that applies to the most banks, just evaluates a bank's record of meeting the credit needs of its entire community. And that's looking at home mortgage loans, multifamily loans, small business loans, small farm loans. And if a bank does if a very large portion of the bank's retail lending business is auto loans, then also looks at auto lending. And so the regulators will kind of look at two different sets of metrics, and there are more published metrics in this version of the Community Reinvestment Act rule than there were in the 1995 version. So these metrics are really just calculations of looking at the bank's activity, whether it's dollar volume or number of loans, relative to usually its deposits or its assets, but generally it's deposits. So first thing the regulators will look at is a volume screen, just looking at the overall level of all of these retail loans relative to deposits in an area compared to what other banks are doing in that area. And then they'll also look at the geographic distribution and borrower distribution of major product lines. So the larger areas where banks are, the larger retail products that banks are originating in those areas, particularly for closed-end mortgage loans, small business loans, and small farm loans. And then, so for geographic, they're really looking to see how many of those are also made in low income census tracts and moderate income census tracts. And then also for borrowers, looking at how many low income borrowers, moderate income borrowers are getting loans, as well as businesses and farms of different sizes. And so then they'll develop a recommended conclusion based on that activity, and they'll also take into account performance, context, and kind of responsiveness in all of that. So there's kind of, in addition to the metrics, there's a layer over top of all of that as well. And then there's also the retail lending services test. This one only has to apply for large banks, so those with $2 billion in assets or more. But really just looking at how responsive the bank's services and products are for the entire community, including low and moderate income families, individuals, households, low moderate income census tracts, and small businesses and small farms. They'll also look at retail services, so considering things like the availability of branches and remote service facilities, and also those digital delivery systems that have become more popular. Considering distribution of branches, and also any recent closures or openings of bank branches, as well as how much digital delivery systems are actually being utilized by low, moderate, middle, and upper income census tracts, and how that's breaking down. And then for retail products, this one can only contribute positively to the overall conclusion. So the services can go either way, I guess, but the products can add to or enhance the performance score for the bank. But it really looks at just what credit products, and for the largest banks, for those with $10 billion in assets or more, what deposit products the bank's offering in their community and how responsive those are to the community needs. So that's kind of the retail test. And again, that applies definitely to intermediate and large banks and small banks at their option. The community development financing test, this one is about loans and investments for community development. And there's a lot of new definitions in this one, particularly just really spelling out what types of activities qualify for community investment or as community investment. And I think the regulators also tried to add a process to make it a little clearer what would get community development credit through this process. So they're really evaluating community development, lending, and investment in facility-based assessment areas, states, multi-state MSAs, and also just overall by the bank. And so they look at community development financing metrics, so just the overall amount of loans and investments relative to deposits, and also are looking at that compared to some benchmarks that the regulators will calculate about other lenders' community development loans and investments in those areas. And again, we'll just look at everything also with a lens of how impactful and responsive is it to the community's needs. And then for banks with $10 billion or more in assets, again, those biggest banks, they'll also look at particularly how much investment the bank is doing, not loans and investments, but particularly investments. And that can contribute, again, positively to a bank's overall community development rating. So I'm just going to run through the categories of community development because I think it'll be of interest to a lot of folks in here. And this is all spelled out in the rule. And again, I'm happy to follow up with folks on specific details on all of this. It's a pretty lengthy rule, so happy to talk more about all of this. But the categories are affordable housing, and there are a number of different types of affordable housing spelled out in there, because obviously that's a big term. But includes rental housing with a government program, including tax credits, includes multifamily, 1 to 4 family rental in some cases, affordable owner occupied housing, and also some qualified mortgage-backed securities. There's also an economic development category, which, has to do with government support for small businesses and small farms, intermediary support for those organizations. There's also community supportive services, so activities that would benefit or help with the health and stability or well-being of low and moderate income individuals. And the regulators give some examples of what that would mean, things like workforce development and job training, childcare, et cetera. Revitalization and stabilization activities. And that's a lot of activities about things like adaptive reuse of vacant or blighted buildings, brownfield redevelopment. So the types of revitalization and stabilization activities that we've seen a lot of going on in Cleveland, honestly. Also includes any activities in targeted census tracts, and there's a definition of that that is both commercial and residential, as long as at least half of it is commercial. And also essential community facilities, things like schools, libraries, childcare facilities, parks, hospitals. Essential community infrastructure is also its own category. Things like broadband, mass transit, water supply and distribution, recovery activities for designated disaster areas after federally declared disaster. There's also a new category of disaster preparedness and weather resiliency, things to help adapt to and keep people safe during weather-related disasters. Many of these activities taking place in native lands was also its own specific category. Activities with minority depository institutions, women depository institutions, low-income credit unions and CDFIs, and then also financial literacy activities. So it's a long list, but those are all different categories that the regulators have identified as community development, where loans and investments can be counted and responsive. And the agencies are also going to be publishing and maintaining an illustrative list. It's non-exhaustive, but it's a list of loans, investments, and services that would qualify for this community development consideration. This is really just to clarify for everybody what will qualify. And they'll be updating that list. And a bank can also request confirmation at any time that a loan, investment, or service would be eligible for consideration. And that's something that I think the regulators had heard quite a bit of feedback on. And so I think this is something that's responsive to try and make sure that maybe new or more innovative activities can get credit. And then the community development services test will just evaluate a bank's record of meeting the service needs of the community. It goes back to all those tests we just talked about, all those specific areas of community development we just talked about, but really including things like volunteer services, that it needs to be a volunteer service related to financial services or the expertise of the bank staff to actually get credit. It's not just any volunteer service, but volunteer services that help contribute to community development. I also mentioned limited purpose banks. I'll just go over this quickly. It's a fairly narrow designation, again, mostly for banks that are not engaged in retail lending, like mortgages and small business loans. But this one, there's a community development financing test specifically for limited purpose banks that can apply. And there's a limited purpose bank designation today as well. So this just kind of continues that and applies a community development test. And then banks can, and this is the case now, banks can always opt to be evaluated under a strategic plan as instead of the regular kind of test that we just described. But the banks have to seek, there's a process for them to go through the regulators to get approval to do a strategic plan. They have to seek comment from members of the public, including through a formal comment process. And there are some provisions that require them to apply the regular performance tests with modifications as part of this as they can. So definitely an effort to maintain the strategic plan, but also keep some of those tests involved. And so I'll just quickly touch on, I think I'll hear about the marquee, banks get outstanding or satisfactory ratings in CRA. So there will still be those 4 statutory, they're in the law, 4 ratings that we talked about: outstanding, satisfactory, needs to improve, or substantial noncompliance, that banks will be rated on overall for the institution. And so there will also be kind of conclusions that are reached at lower levels of the banking organization. So, for states, for multi-state MSAs as well. to kind of evaluate activity within those areas. But the top line evaluation at the institution level will still be, the rating will still be those 4 categories. So a couple other changes just to flag for folks that I think would be of interest. There's no new data reporting required for smaller intermediate banks. But there's a certain amount of data that now needs to be, that will need to be reported to regulators. Part of this to show banks ongoing activity, but also to help banks or to help the regulators set the benchmarks that we talked about that'll kind of be underlying a lot of these metrics that will go into the retail lending and community development tests. Things like small business and small farm lending, home mortgage lending, retail banking services and products data, community development loan and investment data, assessment area data. So all of that will be going to regulators, and also large banks will need to maintain data on the largest banks, $10 billion or more in assets, will need to maintain data on those digital delivery systems as well. And the agencies are also going to publish certain home mortgage loan data for large banks, including things like originations and applications by applicant income, race, ethnicity, in facility-based assessment areas and in their retail lending assessment areas. I know Frank Ford does a phenomenal job of compiling a lot of the HMDA data for the Northeast Ohio region and what type of lending is happening there. The agencies will also be publishing that for banks, for large banks nationwide as well. And then just in terms of transparency, I think one of the bigger differences is that one of the bigger differences in terms of transparency is that banks will, if they maintain a website, they're supposed to maintain their a number of their CRA documents, including their CRA, most recent CRA evaluation on their website. So I'll just flag that. And then lastly, I'll just say, this rule is going to take a little bit to go into effect, but a number of the provisions, it hasn't officially been published in the Federal Register yet, which is the government seal for officially making things fully official. Right now, it's just available in draft text on the Federal Reserve and OCC and FDIC websites. But once the rule is published, the effective date in there is April 1st of next year. Many of the provisions will become effective on January 1st, 2026. Some of the data collection is not until January 1st, 2027. But that's kind of the timeline and rollout. And until this new rule goes into effect, the current CRA requirements will apply. So there's not going to be a gap in CRA, I guess is what I'm saying. So sorry, I know that's a lot of information to just throw out, but that's just kind of taken, and all of this is taken from the rule text as well as a Federal Reserve Board memo that was published by the agency, kind of summarizing things in a nice way. So I put up links to those, and I'm happy again to share anything else that we can with folks, but would also just be happy to take questions if folks have them. And if I don't know the answer, I will track down the right person and get back to you.
Thank you, Megan. We don't have any questions in the chat, but I do have a couple that I can run by you. Do you know when the small business reporting, the equivalent to home mortgage, when does that take effect? Because that could be very helpful.
Yeah, so I believe the small business reporting is part of the 2027 data that will be collected, but also one thing to keep in mind is that there's a small business reporting piece that's in this rule, and that will be required as part of this rule regardless. But the regulators are also really trying to leverage existing data collection, right? HMDA, and also the CFPB has the 1071 small business lending rule that is still going through its process. But when that becomes effective, 1071 will be the kind of mechanism for reporting of small business loan data there as well. So I think it'll be kind of a twofer between the CFPB 1071 rule and this.
Well, I actually am tempted. There's still no questions in the chat. I'm tempted to ask you one more, although I realize that the longer I ask questions, the more I'm putting off. I'm the next speaker. So one thought that occurred to me, and it sort of does dovetail into why have I been doing the research I do? It's because I've been concerned for a number of years about banks getting credit for so many things that, then what's the core thing? What's the core basic requirement of making loans in the community?
Mhm.
And they do other things and then simply avoid making loans in the community. Of course, my research is designed to really put a spotlight on, are they making loans at the neighborhood and community level? But do you have any thoughts on that? I'm not sorry to put you on the
Yeah.
spot. If you don't worry about it, if you don't, I just raising that.
No, absolutely. And I think, that's really, I think where some of these, also the specific metrics, I think will come in. And I am not going to bore you and also not going to pretend that I have the level of expertise that the regulators do on the specific metrics, but they are kind of fully documented in the rule. And I think we'll do a good job of showing the number and dispersion of both home mortgage and small business and small farm lending, particularly where banks have a physical footprint, but also increasingly with the retail lending assessment areas for large banks, the small business and home mortgage lending dispersion for those banks, and kind of looking at how low and moderate income census tracts may be served compared to other census tracts. And same thing for the community development, financing and investment financing test. I think, some of those metrics I think are just intended to kind of add a little more consistency across the board, and also show kind of what banks are doing compared to their peers. But also hopefully with some of the additional transparency that they've talked about, and also having banks CRA evaluations online, that'll also give communities an opportunity to take a look at what regulators are seeing and documenting in terms of activity in their local areas.
Well, we do have one question in the chat, and because we're running late, we may not have time for more than that one question.
Yeah.
Phil Starr is asking, what are the penalties for not meeting any of the metrics?
Yeah, so the metrics go into a multi-layer calculation that ultimately leads up to the bank's overall rating, and the rating is really what determines, I guess, overall the primary enforcement for CRA is just related to mergers and also other kind of bank expansion activities, things like branching,
Yeah.
And mergers. And so if banks don't have sufficiently high CRA rating, they may not be able to engage in some merger, acquisition, or other expansion activities. So that's really the primary way that that CRA is enforced, or kind of comes into play
Right.
in business. But the metrics ultimately kind of all feed up, again, layered with that performance context, all kind of feed up into the overall bank rating.
Yep.